3 years ago, Ryan and Sarah could have comfortably afforded this house. Today, the monthly payment is almost $1,000 higher. Same couple, same income, same house. So, who took the money? Most people blame the bank. They're wrong. The answer is a market so large, most Americans have never even heard of it. A $145 trillion market that just helped decide how much your mortgage, your car loan, and your rent are going to cost you this year. Neither had Ryan until he sat down at the kitchen table, opened a mortgage calculator, and saw 6.6%. He turned the screen towards Sarah. 3 years ago, this was 2.6%. What happened? Sarah shrugged. Rates went up. That's just where they are now. That's the answer most people get, a shrug. So let's actually explain it. I'm Ben, and today we're breaking down the bond market. It has all the personality of a tax form, but it's quietly pricing your mortgage, your car loan, your job security, and the safe part of your retirement account. By the end of this video, you'll know exactly why Ryan's number is 6.6%, why it's probably not dropping back to 2.6% anytime soon, and what to do about it. A bond is just an IOU. The US government needs money, companies need money, and instead of borrowing from a bank, they borrow directly from investors. That's all you need to know about what a bond is. What actually matters to Ryan and Sarah is what happens when interest rates change. Say you put $1,000 into a bond paying 2%. That's $20 a year. A year later, brand new bonds pay 5% or $50 on the same $1,000. Why would anyone buy your old bond now? They wouldn't, not at full price. The only way to sell it is to drop your asking price significantly, low enough that your $20 payment now works out to that same 5% for whoever buys it. Think of it like a used phone sitting next to the new model. It still works exactly as promised, but nobody's paying full price for it anymore. That's the entire rule. When interest rates go up, existing bond prices go down. When rates fall, bond prices go up. Sounds simple, but that one rule is sitting inside Ryan and Sarah's mortgage offer right now. Let's see how. There's a single number that controls more of your financial life than your salary does. The yield on the 10-year US Treasury. Right now, it's around 4.5%. When a bank calculates your mortgage rate, it asks one question. Why lend money to a homebuyer for 30 years when the bank could lend it to the US government, basically zero risk, at 4.5%? The answer? They won't, unless you pay extra. So the bank takes that 4.5% and adds a risk premium, often around 2 points, for lending to an actual human who could lose their job. That's how you land somewhere close to 6.6%. Back in early 2021, the 10-year hovered near 1%, and mortgages briefly touched 2.65%, the lowest ever recorded. That's what Ryan's friends locked in. Then inflation exploded, the bond market repriced everything, and the 10-year surged. Mortgages crossed 8% by late 2023. Ryan stared at the screen. The difference wasn't a few dollars. It was almost $1,000 every month. $12,000 a year. The kind of number that changes vacations, savings goals, and retirement timelines. And all because of a market he didn't know existed. At this point, Ryan thinks he understands the problem. Higher bond yields, higher mortgage rates. Case closed. It isn't. Because the same force that made his house more expensive is about to show up at work. Back in 2021, Ryan's company borrowed cheap money to grow, around 3%. The plan looked brilliant. Then those loans came up for refinancing, and the market wanted closer to 7%. The interest expense more than doubled. A company doesn't send an email saying, "Sorry everyone, the bond market got expensive." It cuts costs, and cutting costs usually means layoffs. Ryan's team lost 2 people that quarter. At the time, it felt like bad luck, a weak economy, management mistakes. But it was the exact same force. Money got more expensive, and someone had to absorb the cost. Ryan saw it in his mortgage. Now he saw it in his paycheck. What he still didn't know was that the same force had been sitting inside Sarah's retirement account the entire time. This isn't just theory. In 2023, Silicon Valley Bank held more than $90 billion in long-term government bonds. Boring assets, safe assets. At least, that's what everyone thought. Then rates surged, and by the rule you already know, those bonds lost billions in value. Customers got nervous, and what followed was one of the fastest bank runs in history. Tens of billions of dollars withdrawn in a single day. Within 48 hours, one of the largest banks in America collapsed. Not because it bought crypto, not because it was running a scam, because rates went up and bond prices went down. The same used phone problem from that $1,000 bond earlier, just with billions of dollars instead. If it can happen to professional bankers, what do you think it did to Sarah's retirement account? Sarah always assumed the bond fund inside her 401k was the safe part. Stocks are risky, bonds are safe. That's the story everyone gets told. Then 2022 happened. Sarah opened her retirement account and saw losses in the section she thought couldn't really lose money. That wasn't because the US government stopped paying its bills. It was the same rule again, interest rate risk. The longer a bond lasts, the more sensitive it becomes when rates rise. Wall Street measures that sensitivity with a number called duration. A fund with a duration of 6 loses roughly 6% for every 1-point rate increase. A fund with a duration of 17 loses roughly 17%. In 2022, some long-term Treasury funds lost nearly 40%. The safest assets on the planet suddenly moved like tech stocks. Sarah had never opened the bond section of her account before. The word bond sounded safe, boring, responsible. Then she looked at the chart and realized she owned something she'd never actually checked. At this point, the bond market has already touched their mortgage, Ryan's job, and Sarah's retirement account. But these are still just symptoms. To understand why this keeps happening, we need to look at the biggest borrower on Earth. The biggest borrower in the world is the US government. Current debt, roughly $39 trillion. This year alone, America will spend over $1 trillion on interest. Not paying debt down, just interest. More than $1 trillion simply to service old borrowing. Here's why Ryan and Sarah should care. Every time the government borrows more, it competes for the same pool of money that helps set mortgage rates. More government borrowing can mean higher yields, and higher yields mean higher mortgage rates. The chain is direct. The government's borrowing cost influences borrowing costs across the economy. In 2025, Moody's removed the last remaining top-tier US credit rating. Foreign investors used to hold over half of all US treasuries back in 2008. Today, it's closer to 30%. The US still has enormous advantages, but investors are demanding more compensation than they used to. And that shows up in mortgage applications, car loans, and credit cards everywhere. Which brings us right back to the number on Ryan's screen, 6.6%. So here's what Ryan and Sarah actually did with all of this. 1. Stop donating money to your bank. The average savings account still pays next to nothing. Treasury bills, money market funds, and high-yield savings accounts pay several times more. The difference can add up to thousands of dollars over time. 2. Know what you actually own. An individual treasury held to maturity guarantees its payments and principal no matter what rates do. A bond fund, like the one in Sarah's 401k, gets repriced every day. Neither is automatically better, but you should know which one you're holding. 3. Check your duration. It's on your fund's fact sheet. Short duration means smaller swings when rates move. Long duration means you're making a bigger bet on interest rates whether you realize it or not. 4. Watch the 10-year Treasury yield. 5 seconds, that's it. When it rises, borrowing gets more expensive. When it falls, the market is usually bracing for slower growth. It's the closest thing the economy has to a check engine light. Ryan and Sarah didn't end up waiting. They bought the house at 6.6%. But for the first time, Ryan actually understood the number on the page instead of just signing where the arrow pointed. And Sarah opened her 401k that same week and finally looked at what was inside that bond fund. That's the real shift. Not predicting where rates go next, nobody can do that consistently. The real advantage is understanding the forces already shaping your life, because this $145 trillion market has been quietly running your mortgage, your job, and your retirement account this whole time, whether you were watching it or not. That's the Ben factor.